Okay, so this analysis argues that the recent, 11% drop in Broadcom stock is really a bear trap.
A massive buying opportunity, yeah. Driven by what it calls hidden AI demand.
And I have to say, I really like the aggressive angle here. The title is strong, and it jumps right into the main issue, that whole margin compression story.
It really does. So let's dive in and see how we can make this argument completely undeniable.
All right, so let's drill down into the core of the bear trap idea. It starts by tackling the stock drop head on.
Right, framing the margin compression not as a weakness, but as a strategic trade-off for huge volume.
Exactly, which is a pretty sophisticated take for an expert reader.
It is. And while the analysis makes a really strong case there, I think demonstrating command over all the possible bearish critiques would just make the report that much more robust.
How so? I mean, it feels like the report pins the whole sell-off on the market, just obsessing over that one metric, gross margins.
And that's not wrong. That was definitely the headline driver.
For sure.
But attributing the entire 11% drop just to that, it might feel a little narrow to a really deep expert.
Okay.
Because market pros, especially in the semi-space, they're always juggling multiple risks at once. CapEx cycles, macro rates, supply chain stuff.
Ah, so an expert might read this and think, okay, you've handled the company's talking points, but what about the structural risks that are always there?
That's precisely the vulnerability. By ignoring those other plausible headwinds, the analysis, it opens itself up to a counter-critique, a critique that says it hasn't considered the full picture.
It leaves an opening for skepticism.
Exactly. So to really fortify that bear trap narrative, the suggestion here is to briefly acknowledge one or two of those other risks.
And then just shut them down?
And then immediately neutralize them with the report's main data points. This moves the analysis from just defending the company line to completely dominating the sector conversation.
So what are those other key risks that a pro would be thinking about right now?
Well, a great example would be to just add a sentence or two addressing the concern around hyperscalers. Them developing their own custom silicon.
The in-house chip development threat. Right.
Or maybe you touch on the cyclical nature of the non-AI business, which is still a big chunk of revenue. Just acknowledge it exists.
And then pivot right back?
And then immediately pivot back to how the 74% AI revenue growth just completely overwhelms those secondary issues. You frame them as noise compared to the main signal.
That's a power move. It shows you're not just reacting, you're preempting the market's other worries. Okay, so from content rigor, let's talk about structure, the flow of the argument.
Yeah, the high-energy tone is great. But in financial analysis, I think authority and speed are just paramount.
Okay.
The analytical impact of the report could be maximized by elevating the most critical data point, that staggering 74% AI revenue surge, much earlier in the sequence. Right now, the first rebuttal to the margin issue, it relies on that conceptual metaphor, the lemonade stand versus the gold mine.
I like that metaphor.
It's good. It's a great hook. But the actual quantitative proof doesn't show up until much later in the fundamentals section.
So it delays the aha moment.
It totally delays it. You're forcing an expert reader to accept the idea of growth before you show them the irrefutable proof of growth.
I see your point. Leading with that 74% number is it's undeniable. But doesn't moving it forward risk losing some of that narrative charm you get from the gold mine analogy?
That's a fair point. But I think in this specific case, when you're countering a sudden, sharp drop in a stock, speed trumps charm.
Neutralize the fear first.
You have to. The goal is to hit them with the problem, margin compression, and then immediately hit back with the biggest fact you have. So the suggestion is to integrate that quantitative evidence right into the initial trap section.
Make the connection between lower margins and explosive growth immediate.
Immediate and undeniable. It ensures the analysis leads with its most powerful, most impressive piece of data.
So instead of conceptually explaining why the margin drop should be seen as a positive, you just prove it is positive with the hard numbers right away.
Exactly. So for example, when defining the reality, the bull case section, you'd lead with it.
How would that sound?
Something like, this so-called margin compression is actually proof that their AI demand is off the charts, having surged 74% year over year.
Okay.
This explosive growth, which is driven by massive, lower-margin AI hardware sales, is what's pulling the aggregate number down. It is not a loss of pricing power.
That framing transforms the entire section. It's not an explanation anymore, it's a demonstration of success.
Right. It maximizes the intensity at the most critical moment of the analysis.
That structural change would absolutely raise the analytical intensity. You hook them, you confront the negative, and then boom, you hit them with the 74% growth. Establishes authority right away.
Yep.
Okay, so let's move to the end, the conclusion and the technicals. The report suggests the stock is in an incredible buy zone, using some key support levels.
It does, and to fully support that claim, that this is an incredible risk-to-reward ratio, the technical analysis needs to establish some specific, actionable parameters for managing the risk.
The risk part of risk to reward.
Exactly. The section does a good job identifying the $350 to $360 zone as key support. Old resistance becomes new support. Classic stuff.
But
But it concludes with a very high-level, sort of emotional assertion. It says, the market just backed the bus up.
which sounds great, but it's not a number.
It's not a number. And for an expert audience, a truly robust analysis defines the specific price point where the thesis is wrong, where it's invalidated. Without that, the risk is just undefined.
That's a critical point. Defining the escape hatch. We see so many bullish reports that are all confidence on the upside, but the risk is just an afterthought. Why is having a specific price floor so important here?
Because it's the difference between conviction and discipline. A professional isn't interested in emotional hype. They need calculated risk.
They need a plan.
Plan. So the suggestion is to quantify the risk by specifying a technical invalidation level, a clear price floor that, if it breaks with conviction, tells the reader to step back and reevaluate.
It provides the framework for disciplined investing.
It does, and that really aligns with the sharp, analytical tone of the rest of the report.
I think that's the hardest part of writing something like this, isn't it? Having the conviction to tell someone exactly when their great idea is actually wrong.
It is. But that defined floor is what turns bullish conviction into an actionable, disciplined strategy.
So what would be a concrete example of that?
Well, you could add something like this. If this $350 to $360 support fails, particularly on a closing basis below $340, that would invalidate the current technical structure.
And require us to reconsider this accumulation strategy.
Precisely. That specific 340 number, it acts as a concrete floor. It immediately provides the actionable risk ceiling that turns a strong opinion into a defined strategic trade.
It completes the equation. It gives you the risk to weigh against the reward.
That's it. That precision moves the analysis from just observation into a real professional prescription.